Monday, March the 7th, European stocks are down, but the bounce off the lows has been huge. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Markets are meant to be a weighing mechanism for risk. I think they're really struggling with that right now. The volatility that we're getting, the price swings, enormous. We've certainly seen that coming in to today. First thing this morning, European stocks down 3, 4, in some cases 5%. I'm talking about the indexes here. We have rallied hugely since then. Yes, we're still down, but look at that. The Stoxx 600 only down by 1%. That feels like a relatively normal session. There was nothing normal about the price picture first thing this morning. Similar story for European gas as well. Huge spike this morning and then a fade off that move. But again, still, we're up by 18, nearly 19% right now. The foreign exchange market's not immune from this volatility. We're seeing Euro Swissy through parity. The euro certainly has had a real struggle. What are we going to get from Christine Lagarde, the ECB president, this Thursday? Kaylee.
Well, Guy, if only that was the only event we're going to have to watch on Thursday. But we also get U.S. CPI inflation data going to be absolutely crucial, as this looks like a market increasingly worried about stagflation, just not quite sure how it's supposed to price that. As we've seen those massive swings in the European session, we saw them too in the future session here in the U.S. When I came into the office at 30 this morning, futures were down hard. Then we saw NASDAQ 100 futures actually going into positive territory. Now the index is back down about 2 full percentage points, right around session lows. So it is a down day for U.S. equities at the moment. When it comes to the action in the bond market, nominal yields aren't really the story. It is break-evens. The 10-year break-even yield right now only up about 3 basis points to just shy of 273. Earlier, though, it was at an all-time high when it comes to inflation expectations over the last decade. You also have the dollar getting a haven bid. The Bloomberg U.S. dollar index trading around 1,200 at its highest going back to July of 2020. And then, of course, it has been a wild session for oil. At one point, WTI was north of 130. Right now, it is just at 119, up still 3 full percentage points, but again, far off of session highs. What a wild ride, Guy, and it's only 11 a.m. Eastern time.
Yeah, still a long way to go for you guys. Mark Dowding, Blue Bay Asset Management CIO, joining us to kick this around. Mark, great to see you. We have an incredibly whippy session behind us here in Europe. The market's really struggling to price the uncertainty right now. Just in terms of the price action that you see in front of you, how useful is it to gauge what is really happening out there?
Well, I think that you're dealing, as you mentioned, with a lot of short-term uncertainty. We're dealing with scenarios as investors, and you're pricing lots of different scenarios. So this sort of short-term uncertainty, I think, is very, very understandable. I guess you try and take a longer-term view and look through some of this, however. And I would suggest, on the one hand, you're trying to price recession risk. On the other hand, you're trying to price inflation risk. But the other thing that shouldn't be forgotten is I also think there'll be a big fiscal policy response that's coming out of Europe sometime soon.
What about the monetary response coming out of Europe, Mark? I mean, how has this changed the equation for the ECB when you have real growth concern on one hand, but what could be even more exacerbated inflation on the other?
Yeah, well, it's a great point. Obviously, we get the ECB on Thursday. We'll be hanging on Lagarde's every word. Obviously, the thing that we do know is Europe is much more impacted here than the US economy is. But in terms of our own modelling, we think that with oil around about $120, you're probably taking about 1.5 percentage points off of economic growth. You're probably putting the same amount onto inflation. And in that context, we think that ultimately we're going to see central banks go down a path where they continue to need to normalize monetary policy during the course of 2022. At this Thursday's meeting, though, I think that Lagarde probably should take the opportunity to kick the can down the road and just wait for a few weeks, given the uncertainty that we're currently facing. But ultimately, we do think that asset purchases will draw to an end at the end of this year. Interest rates up in Q1 in 2023. You probably get rates back to zero by the end of March next year.
Is Europe in that scenario heading for a recession? How does that recession impact different parts of Europe? Or are we talking about, well, maybe you've hinted about this, stagflation?
Yeah, so it's interesting that people were talking about recession in Europe. But I think the thing that you have to remember is we've been looking at this year to begin with. I know that with COVID and now Russia, we're out the frying pan into the fire, metaphorically speaking. But we were looking at this being a really quite strong growth year for Europe. We thought that growth could hit 4% this year in Europe. So even if you're taking off 1.5%, a couple of percent off European growth, you're still looking at a 2% year. I don't think it's going to be recession. If we'd have been starting with a growth forecast of 2, then yes, you would be flirting with recession. But I think recession's unlikely, also because of fiscal policy. You are definitely going to see a load of spending on military, on energy infrastructure, and also on the refugee crisis. And that's why wartime economies don't tend to experience recession, but you have got the inflation risk.
Okay, so what does that mean for European equities relative to other regions of the world, Mark?
So as an equity investor, it's obviously a very uncertain time, right? And there's going to be big winners, big losers as we go through some of this. And these are the themes that the investors are going to have to weigh up. I would say that you're going to come through this where risk premium is going to stay elevated. We think you're going to end up with some sort of stalemate, which puts us into a new Cold War sort of setting that could last for a long, long time. Against that sort of backdrop, risk premia aren't really going to go away. So it's not going to be a great year for investors. We think either in fixed income or in equities this year. The money to be made is more in picking moments in distressed assets. The money to be made is more in relative value opportunities between one name against another or one market against the other, or even in currencies.
When does that environment start to emerge? Because at the moment, this feels like a really top-down macro environments. The baby and the bathwater are being thrown out at the same time. When do you think those price distortions, the inexact pricing is going to become clearer, Mark?
So I think in a situation like this, it normally takes a couple of weeks for people to be able to sit down and reassess their portfolios. There's no doubt that people have come into this set up incredibly badly for it. A lot of fund managers who may have Russian risk in their portfolio, their main thought at the moment is how to get that Russian risk out of their portfolio. There are other things that investors are having to worry about. But you will see, I think, at some point, a situation begin to settle, and you will see people start to look more medium term about what the implications are going to be. I think, though, we may well be another couple of weeks before we reach that particular point.
Does that imply, Mark, that you have Russia risk in your portfolios? And if so, what do you think that Russia risk is worth, and how are you handling it?
Well, I'm happy to say, thankfully not. At Bloomberg, we had a very negative call on Russia. We'd actually, we can put our hand up and say we did our ESG homework, and we had deemed Russia as a pretty toxic place that we didn't want to be investing in. So with the exception of very small positions in a couple of emerging market portfolios that we've been running, we haven't had Russian risk. But obviously, that many others have, and they've been struggling. Here, I think you need to run with the prices that come from index providers. But some fund managers are running into real issues in terms of how to price assets, which then get ejected from the indices, and how to deal with investor redemptions. There are some pretty important questions being asked at the moment. And I would say that in terms of our framework, the adoption of things like swing pricing in recent years has actually been, I think, a benefit in situations like this. But clearly, in the case of some other managers, you're going to see funds needing to close or gate or issue side pockets in order to return money to investors.
So, Mark, is that the kind of environment where you still want to find a way to stay invested, or is it time to shift more to cash, wait on the sidelines until you start to see some of those opportunities, those, individual mispricings that potentially present an entry point?
Yeah, so I think a lot of this depends on your investment time horizon. I would say that if you are looking at a portfolio that didn't have too much risk to begin with, you're now looking at the investment landscape and you're saying, what is dislocating, what is stressed, what can I buy, what can I own? Because there are things that you can pick up at this point in time which look very much mispriced. However, if you're coming into this staring heavy losses in your face, then it's more understandable that actually it's difficult to take the longer term view, and you're probably more in risk reduction mode. But I guess to the audience, I guess my message would be, look, go with the fundamentals. And fundamentally speaking, I think that economies are going to come through this okay in the context of growth. And therefore, you should be looking at the dislocation in markets as an opportunity to buy some assets which are quite cheap. For example, European bank stocks today, this morning, I thought look very cheap when you're looking at assets which are trading at 6 times earnings.
You buying there then, Mark?
So as Bloomberg, we're fixed income investors, but I can put my hand up and say that in my personal portfolio, yes, I was buying an index of bank stocks this morning in my pension because I had actually been in cash and I thought that now might be a decent time to buy.
What else would be on your shopping list, Mark? You mentioned that there are some dislocations now that might present opportunities. Where exactly are they?
Yeah, so as a fixed income investor, there are things that I do think are really dislocated. And some of these, forgive me if they're more idiosyncratic for some of your viewers, but things like European swap spreads, they look really wrongly priced in my mind. There's the 10-year German Bund asset swap spread has reached a level which is way beyond where it traded in 2008. And for that matter, in the sovereign crisis of 2012. So European swap spreads look very badly dislocated. That's really cheap. Other assets that we've been looking at, for example, have been some of the assets in Central Eastern Europe, which are performing just fine, economic and fundamentally speaking. They just happen to be in the wrong postcode. And in some cases, if you've got an asset in Romania and the trader for that asset in a bank also happens to be the Russian trader, of course is marking all the prices down indiscriminately. But here we can look at things and say there's fundamentally value to be had.
There are bits of Europe that are going into this with a very high level of debt. And I hear what you're saying about the fiscal story, which you started off talking about at the beginning of our conversation, Mark. Do you worry that, and it kind of relates to the bank story as well, that as we see debt levels climbing ever higher, that particularly peripheral banks will end up in a situation similar to the one we ended up with in 2012?
So I think that will be a concern for some investors, but I think we have seen, and something that I've been quite surprised by, quite delighted by, is actually the solidarity that we've seen across the EU over the course of the past week in terms of the imposition of sanctions. There's been a real come-together moment. You could say in some sort of ironic, twisted way, Vladimir Putin has done more for European solidarity than many have come before him, right? So, and it's... The truth of the matter here is that, yes, you do need fiscal spending. And look, there is absolutely tragic and upsetting seeing the human suffering and the wave of refugees. But for example, here where spending does need to take place, we would expect that to fall under a common budget, something similar to the next generation EU funding. So when it comes to Germany needing to increase its military spending, that will be on its own dime. But some of these other measures, I think, will be more Euro-driven initiatives. So in that context, it doesn't necessarily hit the periphery per se.
All right, European solidarity, NATO solidarity, probably not exactly running with what Putin originally wanted when he started this whole endeavor. Thank you so much to Mark Dowding, CIO of Bloomberg Asset Management, for joining us. Now, coming up, it has been a wild session for oil. That may be the understatement of the day. Crude seeing its biggest daily swing ever after the Biden administration said it's weighing a ban on Russian imports. The question is, will the allies agree with that? We'll speak with Amrita Sen, Energy Aspects Director of Research, next. This is Bloomberg. Let's talk about oil because it hit $139 a barrel, the highest level in almost 14 years earlier today, while wholesale gas prices for next day delivery more than doubled. And then we've given a lot of that back. This, of course, is as the U.S. hints at a ban on buying Russian energy. Germany, though, not yet on board. The question is, will it get there? Here to break it all down is Amrita Sen, Energy Aspects Director of Research. Amrita, we just had a headline crossing from Darren Woods, the CEO of Exxon, saying we're going to see a tough time in energy markets, which I think is probably a bit of an understatement, and also having a tough time energy traders. What do you make of the price action we are seeing?
I don't think we've seen this level of volatility, and not just, the price of oil, but if you look at spreads, the level of backwardation. I mean, just what does a $5 backwardation even mean? And I think the market's really struggling to price in the scale of what we are looking at, the potential loss of what right now we still have about 65 to 70% of Russian oil not moving, but potentially the scale of if there were to be an oil ban on Russian oil as well. It's just unprecedented in every single sense of that word.
Amrita, if I take a look at the curve, it prices $100 a barrel, north of $100 a barrel for really quite a long time now. Is that what, are we signaling that there is going to be an outage of Russian crude on the market for really quite a long time? If we're north of $100 a barrel, is that commensurate with the reality of no Russian crude being on the market for the rest of this year and some of next?
I would argue that if there's going to be no Russian crude, that curve should be even higher, significantly higher. Like, look, we've had $100 price forecast for 23 to 26 well before all of this, since 3 years ago. Because there's been no investment coming in, spare capacity is limited. And of course, after COVID, we are seeing this big demand surge. So on top of that, if we are to lose a substantial chunk of Russian crude, let's not even talk about all of it, but even if we said lost 3 to 5 million barrels per day, we simply do not have that oil capacity anywhere to make it up.
Well, let's talk more about that capacity. So is essentially what you're saying, even if shale decided to abandon discipline, even if OPEC Plus got off the 400,000 barrels a day monthly increases every month, it won't work? They can't do it?
No, I mean, OPEC Plus as a whole, if you're being very generous, about 3.5 million barrels per day, or I would say make it 3 million barrels per day if you're going to take Russia out of the picture. 3 million barrels per day of spare capacity. Iran, yes, another, let's say, 1.2. Shale, at the very best, I'm talking about another million. And Russia produces over 11 million barrels per day of oil. The numbers just don't add up, which is why prices need to go to the point where demand starts to come off, and that's well over $150.
What kind of clarity do you think OPEC, and I'm also about OPEC Plus here, what does Abu Dhabi, what does Riyadh need to see in terms of clarity around the Iranian talks, around kind of Russian sanctions, and a range of other issues before it makes a decision that it's prepared to put more oil onto the market?
It's a very, very tough situation for them because clearly even OPEC Plus countries are not particularly happy with this kind of volatility or even at these levels of prices, given it will be hurting consumers. The problem, of course, is Russia is a member of OPEC Plus, but also with regards to Iran, as you asked, there is a deal. We still think a deal is nearing. Of course, over the weekend, I'm sure you've seen headlines that Russia's kind of made it more complicated by tying what's going on with Russia, Ukraine to the Iran deal. So it's just that level of uncertainty, because I think the last thing OPEC Plus want to do, although I think that's very unlikely to happen, is that let's say they bring back oil, the Iran deal happens, and Iranian barrels come back, Venezuelan barrels come back for some reason because the US cuts a deal with them. They don't want to deal with that either. But regardless of all of this, the fundamental issue is that Russia is a part of OPEC Plus, and that makes it very difficult.
Okay, Amrita, we've talked a lot about oil. Let's talk about natural gas. How is this situation similar and or different in terms of the dynamics at play and the impact it has if Russia is cut out?
Well, it's probably even worse, in particularly for Europe, because, and we have been talking about this as well, is that you will absolutely have to get industry to cut back on consumption. So we are expecting, and I think you've seen Germany already start to put together a list of potential companies that might have to be curtailed when it comes to gas supplies, because consumers have to be put first. And that's where the real tussle is for gas, because ultimately it's about heating, and we're still not out of the cold yet.
Amrita, is energy transition possible with aluminium up 32% this year, iron ore, steel up by 26%, nickel up by 128%. Can we make the energy transition that will be required if we are going to wean ourselves off Russian energy here in Europe? Can we make it with metals at these kinds of prices?
I think that's the challenge. And look, I mean, in some ways, this gives the impetus to governments to build more renewables, to ultimately push through that energy transition. But even Germany, who's come out and said by 2035, all our power grids are going to be renewables, has also got this fine print saying that, well, we are no longer going to actually kill coal off as quickly as we thought because we need it to bridge the gap. And I think a lot of these energy transition targets will have to be rewritten with raw material prices where they are.
As ever, Amrita, great to get the daily updates as it seems at the moment. Thank you very much indeed. Greatly appreciated. Amrita Sen and the rest of the team over at Energy Aspects doing great work in terms of analysing these incredibly tricky markets. This is Bloomberg. So we're wrapping up the session this Monday. First thing this morning, it felt like there was a whiff of capitulation in the air. There was just massive uncertainty. European stocks gapped sharply to the downside on a massively elevated energy story, which, if you extrapolate, could potentially lead to recession in Europe if energy prices stay as elevated as they are right now. That takes you to the earnings narrative, which is why we saw stock prices come under such pressure this morning. Since then, we've climbed out of the hole. We're not out of the hole, but we've climbed a long way out of it. The FTSE 100 back to flat. The DAX is still down by 1.8%. We're beginning to roll over a little bit right now. The CAC's still down by 1%. So there's still plenty of bright red out there. But this morning it was screaming bright red. So let's just take a look at the session, just to give you an idea of how the Stock 600 has performed thus far. So you get this huge gap lower first thing this morning. We then start to fill it incrementally throughout the day. US futures kick in, that helps. Energy prices start to come down a little bit, that helps. And then at one point we were actually positive. As I say, we faded a little bit since then, but the Stock 600 still trading 417. We're down by around 0.9%, but ugly price action first thing this morning. The other asset stories are important here, so let's take a look at what has been going on. Dutch gas is still sharply elevated, but it's only up by 9% right now. Earlier on, it was many multiples of that. We're still north of 200. We're trading 210. So relatively, energy prices remain incredibly elevated, but not quite as elevated as they did first thing this morning. Parity, Euro Swissy. It's going to be a problem for the SNB. Thomas Jordan. We've got a Christine Lagarde press conference, ECB meeting coming up Thursday. And then you take a look at what's happening with the debt market. Now, this is interesting. So basically what you've got today is a sell-off in the debt market and a sell-off in equities. So you want to pay attention to that. So sort of the balancing act is not working in the way that you might think that it will. The kind of the growth sort of shock story doesn't quite fit with that narrative. That's more of an inflation narrative. And that's the problem that Europe faces right now. It's the problem the ECB faces right now. Which way are they going to go? Because it's a very different policy response if you look at inflation or you look at the growth narrative. Maybe you have to deal with both at the same time. We'll find out Thursday. Anyway, let's move on. Let's talk about what is happening in terms of the sector breakdown. Unsurprisingly, big move higher in energy today. We're up by 4.5%. Energy stocks and energy, not necessarily always moving in the same direction or as closely as you would think. But basic resources are up, metals are up quite strongly. Interesting, the utilities are higher as well. Technology may be looking like a safe haven as well. It's tracked a little bit higher today. The usual suspects at the bottom. The car sector's been hit really hard. The banks have been hit really hard. And that is a narrative that continues here in Europe. How much more downside is there for both at this point? How much risk, how much uncertainty can you price in? Defence stocks continue to do well. BAE Systems out of the UK up by 7% today. Shell, you've got the energy narrative, which is certainly pushing it higher. Interesting comments coming out from Shell a little bit earlier on, talking about the fact that they may be starting to ration, actually, the availability of certain products in Germany. Keep an eye on that. That is going to be certainly something the industry is going to pay attention to. And then you come back to the banks. There you go. Kaylee, Erste Bank, significant exposure into Russia today, down by another 9%.
Yeah, Guy, it's been a volatile day, and that was definitely true for the banking sector in Europe. The Stock 600 banking index at its lows, down 8.2% on the day. Around the close, only down by about 3 percentage points. But that applies to some of the individual banks as well. SocGen, UniCredit, each were down by double digits, some 13% in the case of UniCredit earlier. They were well off those lows, though, by this time. Of course, those, along with Raiffeisen, have the largest exposure to Russia. And it's not just about direct exposure. It's about the potential ripple effects of the Ukraine crisis crisis. What does that mean for the ECB on Thursday and potentially higher interest rates that a lot of these banks have been waiting for? Let's get more now with Bloomberg EMEA Financing Managing Editor Michael Moore. So, Michael, let's talk about the ECB. If we don't get a rate hike this year, which the market has now priced out, how much of the bull case deteriorates for European banks?
Well, I think that's a major issue for the European banks, and you've seen that in the stock price. I mean, if you look at the gap between the way the stocks have been hit and the direct exposure to Russia, it's clearly not just about loan losses in Russia. It is about a lot of the things that were driving the optimism around European banks, the capital markets activity and potential interest rate increases. Those have fallen off, and that has become a major earnings story for the banks.
So this is a growth shock. What about the liquidity situation out there as well? Because the ECB is going to have to think about what it does with TLTROs, the terms of which are going to start tightening up. Liquidity is going to be effectively withdrawn from the market. Is that something that's going to be a problem for the European banking space?
So far, there hasn't been that fear so far. I mean, the banks have been very liquid. They've had a lot of cash. They've, if anything, they've been wanting to find more ways to grow their loans. So it has been less about that and more about the earnings shock, more about, you know, the lack of momentum and the, you know, revenue increases going forward.
Michael, are we going to get to a point where some of these names that do have that large direct Russia exposure are going to have to pull out of that market entirely?
That is, you know, a concern for investors. You know, you have three banks that have a large presence there. Raiffeisen, UniCredit, SocGen have detailed, you know, major exposures. You know, not as a huge portion of their loan book, but relative to the other European lenders, they are definitely the biggest. You know, in the 15 to 20 billion euro exposure there. So there is concern about, you know, what it's going to look like as a foreign bank in Russia going forward, the ability to operate there. So that's something that's on investors' minds. We have not seen any major moves, you know, including Raiffeisen came out last week and said they're going to stand by their Russian unit. So, but that's definitely something that's on investors' minds.
European banking is still very regional. It's still very national. There are a few cross-border banks, but not many. Are we segmenting banks in terms of their geography right now? If we are going to see a growth slowdown in Europe, is that going to hit Italy more with high debt levels and the banking sector there with quite a significant exposure to the sovereign market? How do we think about this sort of country to country around Europe?
Yeah, I think so far it's been, you know, pretty much across the board. Yeah. It's been sell and ask questions later. I think you will start to see some differentiation, you know, among the banks. You know, there's the question of how much does Russian energy matter to specific countries, whether it's Germany or Italy. We've seen that in some of the negotiations around how hard to go on sanctions, you know, and does, you know, are the UK banks less exposed? But so far, what we've seen is it's hit across the board.
Great stuff. Michael, thank you very much indeed. Bloomberg's Michael Moore leading our bank's coverage. What a few weeks it's been for that sector. Let's take a look at where European stocks have settled. As I say, this morning, the price action, absolutely epic. A massive gap off the open versus Friday's close. As I say, we filled that gap largely, not completely in the case of the DAX or the CAC 40, still down by 2%. 1.33%. The London market, though, obviously heavy with energy stocks and heavy with metal stocks, has certainly come back a very, very long way, though still trading sub 7,000. We're going to carry on the coverage at the top of the hour. We'll analyse the political events that we've seen today. We've seen that press conference between Boris Johnson, Mark Rutte, and the Canadian Prime Minister Trudeau. We'll play some of that. We'll analyse what the implications are for the UK. But the markets all over the place at the moment. We'll try and get some analysis on what is happening there, Kaylee.
Yeah, we continue to follow those markets, but we'll also get more political analysis this hour. Coming up next, the third round of talks between Ukrainian and Russian officials are underway in Belarus. We'll discuss with Edward Lucas, Center for European Policy Analysis, non-resident senior fellow. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Rishika Gupta, and you're looking at a live shot of the principal room. Coming up, Angela Stent, the professor at Georgetown University School of Foreign Service, joins Bloomberg Television at 12:30 New York time. This is Bloomberg.
So CERAWeek, which is one of the world's most influential energy conferences, is kicking off today in Houston. Bloomberg's Kriti Gupta is there and caught up with the EQT CEO Toby Rice. They spoke about record European energy prices and why American natural gas seems to be so well insulated.
Certainly, there's definitely a demand for energy that's produced responsibly, and there's no better place in the world to get your energy than the United States. We produce our energy cleaner and more responsibly than anywhere else in the world. And certainly the world is moving towards, there's a call for clean energy. Natural gas and the producers are here to step up and meet that demand. But we can only do so much. And right now in the United States, in the Marcellus, we are out of pipeline infrastructure. So for us to do more, for us to step up and serve the American people, for us to serve the world, we need simply more pipeline infrastructure and more LNG facilities to connect our low-cost, responsibly produced supply to the world.
Well, you mentioned stepping up for the American people in particular. That's a message that you've heard from the Biden administration. You've heard it from the Energy Secretary, of course, and of course the regulatory bodies, environmental or not, really across the country. Has the Biden administration in particular reached out to you?
So we're really excited to see the Biden's, the administration talking about energy. We have not had those conversations directly with the administration, but to see that now that they're talking about putting sanctions on Russia and Russian exports, that's them being serious about energy. You know, to be able to pull off something like that, you need to know that you've got a powerhouse of an industry ready to step up. That is the American oil and gas industry. And so certainly there's a recognition from the Biden administration that this industry can do a lot and help mitigate any impact it's going to have on the American consumer.
So what do you need from the Biden administration to ramp up production to meet that goal?
Real simple, like I said, pipeline infrastructure and LNG export facilities. You know, we need to build those pipelines faster and LNG facilities faster than we've ever done in the past. That's one thing. The other thing, though, is we need his voice. We need a very simple, send a political signal that natural gas is the energy of the future. The United States has the ability and desire to help meet world demand for clean-burning natural gas.
That was the EQT CEO Toby Rice speaking from CERAWeek. And we'll have a lot more from CERAWeek, including interviews with ConocoPhillips CEO Ryan Lance and Vicky Holub, Occidental President and CEO. Meantime, the third round of talks between Ukrainian and Russian officials are underway. For more, we'll bring in Edward Lucas, Center for European Policy Analysis, non-resident senior fellow. Edward, thank you so much for joining us. Of course, as we see war continuing to rage in Ukraine, we now have the U.S. considering an import ban of Russian oil with or without its allies, and it seems Germany is still not on board with that idea. Do you expect that the West can coalesce around an embargo?
I don't think all Western countries are going to support an embargo. Some of them are really so dependent, which is, of course, entirely their own fault. They've allowed this dependency to develop over the last few years and also phased out nuclear power stations and their own coal and, in some cases, gas supply to increase it. So it's going to be difficult. But I do think that the West is getting together far faster and far more decisively than anyone could have expected 2 weeks ago.
What do you think the objective of these sanctions, these energy sanctions, are ultimately going to be? There seems to be a message that effectively Europe and the world, but Europe more importantly, is effectively now on track to try and wean itself off Russian energy, and it's going to do so at an accelerated rate. If you are Vladimir Putin and you're looking at this, you're thinking, well, this is now going to be a permanent change in behavior. So my question is, if that's the case, what effect do these sanctions actually have? Because clearly he is now thinking, even if I pull out of Ukraine right now, this process is now going to be unfolding. So therefore, what purpose does this have?
Well, Guy, you're right. If Putin was really worried about the Russian economy, he wouldn't have been running Russia the way he's been running it over the last few years, which has led to low or nil economic growth and a lot of quite unnecessary backwardness and its estrangement from the world economy. So I think that the sanctions are partly a sign of solidarity. They're a way of getting everyone into the same space when it comes to other policy measures as well. They do cut off some supplies of money and indeed spare parts and other things to the Putin war machine, but they're absolutely not a silver bullet. And I think that we tend to rely on sanctions rather too much. And the story of places like Zimbabwe, North Korea, and Iran is that even economic immiseration of the population doesn't necessarily lead to a change in policy by the regime if the regime's absolutely determined to carry on doing what it's doing.
Okay, Edward, so if not sanctions, then what? Use of force?
I support visa sanctions for a start, but visa bans are much, much quicker than economic sanctions. So we need to go and find the top 1,000 or top 5,000 people in Russia and say, not only can you not come to the West anymore, but your children, your spouses, your siblings, your parents, and your in-laws can't come either. And that would be a really big hit because these are not the oligarchs. Oligarchs is a kind of 1990s term. It has much less relevance in modern Russia because Putin really but these people, the elected officials and the parliament and in tops of ministries and in power agencies and in the lie machine and the war machine, they have relatives who really like coming to the West. And we can say not anymore, no more shopping at Harrods, no more holidays in the south of France, no more going to German doctors. All that's over now. And that would put some pressure on, I think.
Well, Boris Johnson was talking about this a little bit earlier on in the press conference with Trudeau and Mark Rutte, talking about the fact that he hopes the economic crime bill is going to get royal assent, i.e. approval, over the next few days. This economic crime bill, which is also the economic crime bill and transparency and enforcement bill, Edward, is effectively designed to figure out who are the ultimate beneficiaries of assets. And this kind of goes in the same direction you're talking about. Are we moving quickly enough to identify the people you refer to and identify their interests in the West already and start to limit access to those? What impact do you think that will have? And do you think we're moving fast enough?
No, we're not. And I would change the word effectively in your question to performatively. This is basically about showing off. It's giving the illusion that we're doing something, but we're not. First of all, the time scale is far too long. We're giving people plenty of time to move their assets out of the country. And more importantly, our enforcement mechanism is broken. We are absolute rubbish in this country at prosecuting all kinds of white-collar crime, and particularly against going after the kinds that are protected by expensive lawyers. So this is a kind of performative whack-a-mole where we will go after a couple of high-profile targets, but I don't think anything will happen. The difficulties here are enormous. We need to turn this around and say something quite different, which is that shell companies no longer have access to the law, because most of this money is hidden behind these shell companies, anonymous. They own companies where you don't know who the beneficial owner is. And rather than trying to force them one by one to say who the owner is, we should say none of you have access to the courts. You can't sue and you can't be sued until you produce a real person. And that would turn them into outlaws and would force them to fess up who really owns them. And if they don't, I do one more thing, which is to say if you own high-end property, that property is forfeit within a year if you don't show who a real owner is. And that would clean up our system from this scourge of anonymous companies, whether they're onshore ones in Britain or from the British Virgin Islands or from North Dakota or Panama or wherever.
Okay, Edward, but even if those sorts of steps were taken, if we continue to see an escalation in retaliation, in sanctions, is it just reducing the amount of off-ramps available for Vladimir Putin? Do we get to a point where there is no off-ramp?
I'm not sure that Putin really has an off-ramp at the moment, and I'm not sure it's our business really to give him one. I think that these attempts to second-guess Kremlin decision-making almost always end badly. We've been warned about this for decades, and we've always taken the path of least resistance. And the result is that many thousands of Ukrainians have died in the last 8 years, and many more are dying right now. So I think that what we need to do is to support Ukraine very hard and provide a mixture of intelligence and military assistance to enable them to continue to tie down and beat the Russian army. We need to beef up our presence in our NATO allies and make Putin think that, gosh, the West is looking really scary. And once he's scared of us, then there's a chance that we may get somewhere. But I have to say this is the most dangerous security situation in my lifetime, and probably in the lifetime of anyone watching this program. We've left it far too late, and all the ways out look pretty perilous.
Edward, we'll leave it there. Thank you very much indeed. Edward Lucas of the Centre for European Policy Analysis. Thank you very much indeed. This is Bloomberg.
All right, so the European session is over. It saw the Euro Stoxx 50 closing in a bear market. U.S. markets, though, still open and trading. They, too, are moving to the downside. So let's get a check of where we stand. Bloomberg's Abigail Doolittle is here with that. Abby?
Well, interesting signals here, Kaylee, because we have the S&P 500 down sharply, similar to those European markets, down 1.6%. Not surprisingly, the VIX is higher at almost 34. On the other hand, you have bonds pulling back, too. So it's not fearful selling. It's more the volatility that we've gotten used to this year. And a big piece of course, is oil. At the highs, WTI crude overnight up 13%, then almost flat earlier today. Right now, up 1.8%. One reason to think that crude oil is likely to pull back, it is way overbought. If we go into the Bloomberg terminal, we are going to see that it's 14-day RSI basically at a 74. That is the highest level on the upside going back to April of 2008, and it exceeds other points. So again, there's reason to think that this momentum that we've seen to the upside may pull back. If that happens, that could help out stocks, because if we take a look at the relationships between stocks, the S&P 500 in particular in orange, and then in blue, the 10-year yield in oil, you can see, interestingly, over the last 6 months, the 10-year yield in oil have basically traded along, very connected, correlated, pushing the S&P into this volatile range that we've had over the last 6 months. But as oil has gone parabolically higher, it has pushed down yields, and it's certainly pushed down the S&P 500. But it has pushed down even more so the German DAX. Of course, Germany more sensitive to oil than the U.S. is, given the dependency and Brent crude. Here we have in white the S&P 500 over the last 2 years. In yellow, the DAX. You can see over the last 2 years a very strong correlation. The German DAX and the U.S. S&P 500 have basically traded in lockstep. They, this year, have also traded in lockstep up until just recently. Take a look at this. The German DAX absolutely plunging down as the S&P 500 kind of hangs in there. The DAX now down about 23% from its peak, the S&P 500 down 11%. The question, Guy, is the S&P 500 going to follow the DAX, or will the DAX reconnect to the S&P 500? Maybe somewhere in the middle, but this could certainly be a year of a rolling bear market with bouts of rally to the upside, but to the downside, you can really see that DAX looks pretty ugly.
Yep, the European story, very uncertain at this point in time. A lot of people really struggling with that uncertainty, and sell first, ask questions later. Abigail, thank you very much indeed. A couple of things just worth noting. So the Cheniere headline, the code is LNG, the ticker symbol. We are sold out of gas until into the 2040s. So what are we watching for the next 24 hours? That's quite a long-term story. The US Senate opens 3 p.m. Lawmakers are back in D.C., focus on the funding of the government ahead of a March 11 deadline. We're watching that. Tomorrow, Kaylee?
Well, tomorrow it's International Women's Day. We're going to get wholesale inventories here in the U.S., German industrial production, Eurozone GDP, plus China inflation numbers will be out tomorrow night. And, of course, geopolitics will remain front and center. They'll be talking about that next on Balance of Power on U.S. TV and radio, the cable on DEB Digital.